Greetings and welcome. I'm Pharaoh Trader and you're watching The Trading Mindset. In this video, we'll be discussing the 4 out of the 10 trading core fundamentals that I've developed in my experience and profession. Please follow me along this journey and may we all come out of this better traders for it. The Trading Mindset. Most people come to trading chasing money. Professionals come chasing mastery. The right trading mindset begins the moment you accept the hard truth. The market owes you nothing. It doesn't reward effort, intelligence, or desire. It rewards discipline, patience, and respect for risk. Once you stop trying to force the market to give and start focusing on how well you execute your process, everything changes. And that is the purpose of this course, to get you to stop expecting things from the market and start taking things from the market by executing your process perfectly every time. Win or lose, the process must remain the same. The 4 core fundamentals we'll be focusing on are as follows. Price is not value. Markets move based on perception. There is reason for every move, and markets punish impatience. To start, price is not value. Price is an agreement reached under pressure. Value is what remains after emotion fades. In the short term, price is distorted by fear, greed, leverage, and forced liquidations. Fear compresses time horizons. When fear enters the market, participants stop asking, what is this worth? And they start asking, how fast can I get out? This causes panic selling, liquidity vacuum drops, overshoots far below intrinsic or structural value. Fear-driven price moves are about survival, not truth. When greed enters the market, greed expands expectations beyond reality. Under greed, future gains are pulled to the present. Risk is mentally discounted, and participants chase momentum, not fundamentals. When leverage enters the market, leverage magnifies emotion, not intelligence. When leverage dominates, small price moves trigger large reactions. Traders are forced to act regardless of conviction, and markets become reflexive and unstable. When forced liquidations enter the market, forced selling has nothing to do with value. Liquidations occur when margin requirements are breached, risk managers override judgment, and capital preservation replaces decision making. So guys, what I need you to understand, especially with this concept, is that price is not the value of your underlying stock or asset. Price is simply an interaction between buyers and sellers at a certain point. So do not be confused when your analysis of a certain instrument doesn't go your way and you believe that your analysis was wrong. No, your analysis can be perfectly right, but the price cannot match the value because the price is being influenced by outside measures, such as fear, greed, leverage, and forced liquidations. So just understand those things. Moving on. Markets move based on perception. Markets are forward-looking. They don't wait for the full truth. They react instantly to how participants interpret information. It's not the headline itself, but the context of positioning and liquidity that determines the move. What does this look like? You need to ask yourself these questions. Who is positioned? If most traders are already long, even bullish news may fail to push prices higher. Conversely, if sentiment is overly bearish, bad news may have little impact because it's already priced in. Secondly, ask yourself, who is trapped? Traders caught on the wrong side of the move might exit quickly, creating forced buying or selling. Example, a surprise rate cut traps shorts, forcing them to cover and thus driving prices higher. Thirdly, ask yourself where liquidity sits. Markets gravitate towards areas of high liquidity, places like stop losses, clusters, option strikes, major supports and resistance areas. Right? This is where price goes towards. So you need to be able to identify these areas and be able to place your trades and your entries in accordance to these areas. Because if you do not, you might get caught in a trap and become liquidity yourself. News acts as a catalyst to push price into these zones, triggering cascades of orders. And that's how traders, usually retail traders, get trapped. And that's how entire portfolios collapse. What's the lesson here? Instead of asking, is this good or bad news? The sharper question is, who does this hurt? Does the news force a large group of traders to unwind? Does it expose crowded positioning? Does it shift liquidity to vulnerable areas? This mindset shifts focus from headline narratives to the market mechanics. And that's what we need to understand. Market mechanics. How the market moves, why it moves, and who is moving it. This change in mindset can alter your entire trading journey. Moving on. Every move has a reason. Markets are structured systems. Every tick reflects an interaction between buyers and sellers, and behind each move lies intent. What looks like noise is often markets fulfilling one or three core functions. 1. Triggering stops. Stop loss order clusters around obvious levels, support and resistance, and round numbers. Price often hunts those zones to unlock liquidity before resuming its trend. Example, a sudden dip below support may not be a sign of a bearish movement, but rather a liquidity grab. So again, do not be a part of the liquidity grab. Make sure that you understand why price is moving so you can enter at the right spot to become profitable. Secondly, to fill orders. Institutions can enter or exit positions in one shot as we can. They need volume. Price moves towards liquidity pools to facilitate institutional execution of these orders. What looks like random chop is often accumulation or distribution by said institutions. And finally, to rebalance exposure. Funds rebalance portfolios based on risk, volatility, or macro shifts. This creates flows unrelated to headlines but deeply tied to risk management. Example, end of quarter rebalancing can cause sharp moves even without news. So again, guys, a firm understanding and fundamental analysis is also required for you to become a strong, profitable trader. I know we're going to mostly focus on technical analyses, but you need to be able to understand the functions of your underlying asset or stock to be able to predict certain moves in the market, right? Because if if you're trading gold and all of a sudden the gold trading countries limit the supply of gold, it will affect the trade of gold, you know? So regardless what the technical analysis is doing, there's also the real world functions of this asset that you must keep track of. Moving on. The market punishes impatience. Markets are designed to exploit emotional weaknesses. Impatience is one of the most common traps because it leads traders to act without context, discipline, or edge. Every impulsive trade becomes liquidity for someone else, usually the patient, prepared trader. What does this look like? This looks like chasing candles, jumping into a move after it's already been executed and extended. You buy tops and sell bottoms because you're reacting to price, not anticipating structure. The market rewards the patient trader who waited for the chase to exhaust before entering. It looks like forcing trades, entering positions without a clear setup, just to be in the market. This often leads trading low probability conditions where noise dominates signal. The market feeds on this by whip spawning impatient entries. Understand this. This is how you become liquidity. Do not allow noise to make you a liquidity trader. Don't let noise kill your account. Needing action. Trading for stimulation rather than opportunity leads to overtrading, commission burn, and emotional fatigue. The market punishes this by draining capital and confidence. If you continue to trade useless setups and nonsensical structure without sticking to your rules and regulations, you will lose confidence as you lose more and more. And when your structure does show up, you either trade very low without confidence or you won't trade at all, defeating the whole purpose of trading. So what are the mechanisms that the market punishes you? Buy. The impatient traders provide liquidity at the worst possible levels. Their stops become fuel for larger players. The entries mark exhaustion points, allowing patient traders to fade them. In essence, impatience is the market's food source. Every rush trade strengthens the hands of those who wait. Thank you guys for being with me. These are the first 4 of the 10 core fundamentals that I will be discussing. Please reflect on these, understand them, and if you have any issues, please don't mind commenting in the section and I will respond to you promptly. Please like, share, and subscribe. Thank you again.